Okay, today we're looking at the stock market of the 1920s. We've already talked about the industrial rise in the 1920s, how electricity led to the industrial rise of the 1920s, this idea of consumerism, really productive times from a business standpoint and from an industrial standpoint in the 20s. But today we're going to focus on just the stock market of the 1920s. So, maybe. So let's review stocks real quick. Let's talk about what stocks are, how they work. We talked about this earlier in the year when we were talking about the corporate system that emerges during the second industrial era, but it's worth reviewing because it's a key part of the economics of the 1920s and also the economics of the 1930s. So basically stocks, it's purchasing a share or a small piece of a company. It works out good for you, the investor, the individual, because you get a small piece. You are essentially owning a share of that company. The more shares you buy, the more of that company you own a piece of, essentially. All right? And as that company does well, as the performance, as they sell more, that increases the value of those shares. So let's say you pay $1 for it, for each share. A year later, the company's doing well. The value of that share could go up to $5. So if you sell it at $5, you've just made a $4 profit. All right, so it's an investment, but it is kind of risky. Just as well as the stock can go up, the stock value can go down. So say the company's not doing so well, you paid $1 for that share. A year later, maybe it's only worth $0.25, so now you've lost 75 cents. So stocks are kind of risky, but they're an investment. In the 1920s, they're a pretty safe investment. What does the corporation get out of it? When they sell these shares, sell these stocks, the business gets money called capital, which they then use to invest back into their company. They can build more factories, they can hire more workers, basically expand and grow their corporation at a much faster rate than the traditional methods of industries and businesses would use. So it's kind of a win-win for both people involved from an investment standpoint and for a business expansion option. So when we're talking about the stock market, we can have a couple different scenarios. The bear market versus a bull market. A bull market is the nickname given to a stock market that's doing particularly well. So you'll see stocks, the values start to go up. Sometimes you see these charts, like the one in the upper left-hand corner here. That's a bear market stock. When the stocks start to drop, the prices drop, that is a bear market. But when things are going well, that is a bull market. So in the 1920s, we are definitely in a period of a bull market. Think of like the bull, the horns on the bull. He's going to like take his horns and shoot the stock market up. And think of a bear with its big giant claws, and he's just going to swat away and tear down the market, the stock market. But not this cute little bear. He just wants honey, that's all. Okay, now, one of the other more popular methods of buying a lot of these consumer goods in the 1920s was installment buying. All right, you couldn't afford the new latest, electric cooking stove, or you couldn't afford a new vacuum cleaner, electric vacuum cleaner. No big deal. You could just pay a little bit up front and then make some small payments each week or each month until you paid off the entire value of that stove or vacuum cleaner or whatever. Now, that installment buying principle gets applied to the stock markets in the 1920s. It's called buying on margin. So same idea, you're not going to pay the full value of the stock, you're just going to pay a small portion of it, and then each week or each month, you then pay the stockbroker, the guy who's like in charge of selling and buying stocks, he's the guy you go to. He will then cover the rest of the cost. You are now in debt to the stockbroker. So each week, each month, you pay a little bit more towards the stockbroker until you've paid off the full value of the stock. It's a win-win because throughout the 1920s, the stock values seem to keep going up and up and up and up. It's a safe bet, so everyone thinks. So it's no big deal to say, like, sure, as a stockbroker, let me loan you some money so you can purchase this stock, and it works out for the broker because he's going to be receiving a weekly or monthly payment from you, and he's going to be making a little bit of interest on this. So he's actually making money off of loaning you the money for the stock, and you get to purchase more stock, which keeps going up in value. So of course you'll be able to pay off that stockbroker and the debt you owe because your stock values keep going up. So once the stock value goes up, you sell it, you can pay off your debt, and you still make a profit off this. The stock market seems like a surefire bet throughout the 1920s. However, the problem, the stock market can't keep always going up forever. All right, there's always going to be a part where we have that bear market and it starts to go down. One problem you get is speculation, this quick turnaround. People were selling stocks, not really investing, holding onto it to a long term. They were buying it, turning around the next day, selling it. This short-term speculation kind of hurts the market, makes it unpredictable. The other problem, if you have so many people, the majority of people purchasing stocks in the stock market, if they're all buying stocks on margin and say the prices do start to fall, what the brokers will do, because they get a little nervous, they will start to call in these margins. All right, they'll make a margin call. They'll call you up on the phone and say, hey, listen, the stock market took a little bit of a dip here. You still owe me $100 on the stocks that you purchased. You need to pay up right now. And if you can't pay up right now, if you don't have that cash on hand, well, now you have to sell. Basically, you have to give up your stock to the broker. The broker is, he's in a tough spot because he doesn't have the money for the stock. And then he starts making more margin calls. The value of the stock starts to drop. He's not getting the money on all the stocks that he has loaned out. And it kind of snowballs into the situation where stocks are getting sold. The brokers are losing out on money. And it creates this full-blown panic. And it just kind of gets worse from there. All right, so you don't have the full value of these stocks paid off. So people are losing money, and they're losing it quick. All right, so just a quick visual on how this all kind of works. All right, you pay 10% of the stock. The broker pays the other 90%. All right, so now you're paying, like I said, a small payment each week or each month until you pay off the full value of said stock. So you're also paying a little bit of interest to the broker. So, I mean, you're not just getting this money for free, right? Like, money doesn't grow on trees. It's not certainly free. That broker is expecting that you pay a little bit more money on top of the money that you owe, so he actually makes a profit. You're paying for the luxury of getting that loan, essentially. But once the stock prices start to drop, right? Once the arrow starts to go down here, now your pockets are inside out, you're broke, you have no money, which means you can't pay off your stockbroker. He's like, oh, but wait a minute, you owe me money, but oh well, you have no money, which leads to you and the broker and everyone else who's been paying, buying their stocks on margin, and all the other brokers who have basically stuck with all this debt from the loans that cannot be repaid. You guys are all now living in a van down by the river. So it's a slippery slope. This reaction when the brokers start figuring out what's going on and they start tallying up, how much money they've lost, this creates sort of a panic, all right? More and more people start to sell their stock, and once they start doing that, more and more people start to sell it, the value starts to go down. And more people sell, the value starts to go down a lot quicker. And then this compounds the issue because now you're adding more to that debt, all right? The brokers are going to try and make that margin call, but again, there's no money to be had from the people who bought the stocks initially. And this is actually what creates this stock market panic in 1929, which we'll talk more about when we get into the Great Depression. But this is one of the major issues, a huge financial flaw here. There was no government regulation, overseeing the selling of these stocks. This is a really risky way of doing stocks, and only putting down a small fraction, just 10% of the value of a stock, and having the broker carry the weight of that debt. That's very risky. Like we said, stocks aren't guaranteed. It's a kind of risky. The business makes a wrong move, the value could shoot down. But in the 20s, everyone felt everything was going to keep going up. There was nothing really pointing otherwise, so everyone felt safe about buying on margin. But when it starts to go down, it goes down quick. And like I said, people freak out, people start selling their stocks, the brokers are left holding all this debt, and it's a real big issue. All right, that's it for the stock market of the 1920s.